This is Brennan Decima with Decima Wealth Consulting. Thank you for joining. In our last video, we discussed how individual bonds work, how bond ladders work. But what happens if you don't have enough capital to spread the risk around, to diversify credit risk, to plan for liquidity risk, to set up a cash flow stream? Well, that's where bond funds come in. So a bond fund is a pool of investments, right? So the bond fund may own thousands of different bonds, all different types of issuers, all different types of maturity. So the benefit of this is twofold. One, you have diversification. So if you have 1,000 bonds, even if one goes belly up, it doesn't really make a dent in the grand scheme of the fund. Number two, you have professional oversight, where a fund manager is making sure that even though there is 1,000, they don't want any to go belly up. So they're looking at the credit ratings and the probability of success so they can get in front of potential material events. So the advantage of this is it really minimizes credit risk. It gives you active oversight. And it's also simplicity. Instead of having 20 bonds in a bond ladder, you can have one or two bond funds, a short-term bond fund, an intermediate-term bond fund. Now, the disadvantage of this is bond funds do not have a set maturity date. With an individual bond, no matter what, as long as it doesn't default, you're going to get your principal back at the end of that maturity. Whereas with the bond fund, that bond fund rises and falls every single day based off interest rates and the underlying value of the bonds inside. So you're still going to receive income, but the fund is constantly buying and selling. So there's going to be more volatility with bond funds than there would be with individual bonds. So this can be really confusing if you're in retirement, you buy a bond fund, it has a yield of 4% or 5%. But your cash flow isn't 4 or 5%. And that's because every month that yield on the fund can change. So significantly more simple, significantly more diversified, but as a trade-off, you're giving up predictability. You have less defined time frames like you would with individual bonds. So the simplicity of the fund is great, but the predictability is a little bit more up in the air. And that's where target maturity laddering ETFs comes in. So how do we get the best of both worlds? Having a hybrid concept. So a couple companies do this. You have Invesco Bullet, you have iShares iBonds. But in our next video, we'll talk about how do we get a hybrid of the fund and the individual bond and what role does that play.